All right, I shall begin with a very big, and I'm talking about a very big hello to all of my friends out there inhabiting the universe, or anyone who decided to stop by at this precise moment to watch this video. My sole intent during this presentation is to educate you and open your eyes to perhaps an event that we will experience here in the near future. Now, please do understand me. I'm simply taking some information I've recently collected, and I'm going to say on a scale of 1 to 10, the amounts of information which I collected is around a 6 or maybe a 7. I didn't go like overboard with this. I just got some scratches at the top of my head. Thought I'd share it with my good friend and peeps out there in the trader world. I'm going to take this. I'm going to send it your way. You do whatever in the hell you want to do with it. But I want you to pay a little bit of attention to this, because there are some similarities that I'm having here. I'm not going to say doom and gloom, market crashing here. There are some things that are reminding me. I'm smelling 2001, 2008. And we're going to talk about this in steps, about certain things that are happening in our financial world, and we're talking about our personal world and the way that we look at trading and investing. So I'm going to begin with Wells Fargo. Most of you out there in the trading community should already know this information. It's been quite public, but I want to divulge on it here for just a little bit and tell you where I'm going with this. First of all, it was just about a week ago, Wells Fargo tells its customers that it's going to be shutting down all personal lines of credit. Now, at first glance, that's obviously a pain in the ass to Wells Fargo customers, but there's a deeper meaning for this to me, and here's where it is. I'm going back to 2008 here, and again, I'm not saying we're replicating what happened in 2008, but when you look back there at all of those banks, they were all involved in predatory lending, which we all know this now. But when it was all said and done and the dust had settled, the majority of the banking institutions in the United States had gone under. In fact, there was only one bank who scathed any damage from that crisis, and who was it? It was Wells Fargo. Because Wells Fargo pulled out of predatory lending far before 2008 and far before the crash, at which time they took some heat for it, very much like they're doing now. Now, if you can't put two and two together, I was thinking here, Wells Fargo seems to know things ahead of time, or at least act upon things where they see risk ahead of time. So where I went from this is what it reminds me of. So I know you newer traders that didn't trade at 2008 wouldn't remember that. And that doesn't mean that, current times are going to replicate past times. I'm just drawing some lines in my head here again. Do what you want to with it. So I started to think about, now, why would they do this? We're obviously in a free money environment here. People are at a crazy spending spree everywhere you go, it seems like. Money's just frothing out of the universe here. Why now? Why did they do this? So here's the extent of my research, and I call upon you guys out there, if you want to take this discussion a little bit further, I would gladly do it. I looked up and I found a few things where I didn't get any specific charts, but I went to the Federal Reserve website and a couple other things, and I found that mortgage debt has now been in record growth during the pandemic. Now, I'll give it some credit here that most of that is done because we've had a booming economy. Most people have been able to keep their jobs and work at home, and this real estate market has been very lucrative. So there's an early cycle there where we're in a booming market with real estate, and of course you're naturally going to see record growth, in real estate. However, it's the amount of debt that's currently being out there. So when we're talking about Wells Fargo and we're talking about personal lines of credit, this is money that people have on their escalating real estate prices. Now, I want you to hold that thought, because we're going to get to that here in just a second when I start talking about the market. What interests me more here is that I looked up some stats when it comes to the debt percent. What has happened since coronavirus, since we've all been on lockdowns here? The percentages of debt have almost doubled for most people. So you're looking, I just popping this charts up here, Federal Reserve Consumer Finances. Anyway, this shows you the income bracket. I think what I'm finding a little bit interesting here is those that are making anywhere from $60,000 to almost $100,000 have increased their debt loads by 55 to 56%. Now, my only thought I can think of here first off the top of my head and on the fly here is the economy isn't as good as we're thinking that it is. And maybe you combine that with inflation, because we all know inflation is a serious concern here with these escalating real estate prices, with escalating used car. I mean, everything's been in a bubble. You've had lumber, you've had copper, you've had bitcoins, you've had everything blowing up in a bubble, real estate bubbles. This was just one massive frothy bubble that we've got going on. But getting back on point, the debt has grown significantly across the board for most people. So what's happening here is that obviously people are borrowing more and more money. Now, whether they need to borrow this money for survival, or they're borrowing this money for something else because they want to maybe go on a vacation, repair a home, or fix something, or maybe pay down another more extravagant debt. There could be many reasons for this. So it's either you have to have the money, or you're taking the free money because it's sort of being forced down your throat. I still today get several phone calls over and over again about should give me some free money. I've talked about this before in several videos, so I'm not going to talk about it again. So let me talk to the market, because I want to talk about the market, because I have a theory here. I feel that what you're witnessing in the market this year of 2021 is going to be a once in a generational ordeal. It's sort of the perfect storm that had come together, where when you think about coronavirus, people being locked down, they instantly got more free time. Some people were out of work. Some people were allowed to keep their jobs. And of course, when you're keeping your job at home, most people aren't as working as hard at home as they are in the office, right? So there's more free time. There's more free time to do things around the house. Combine that with a booming real estate market and a booming stock market. It's just natural that more and more traders would migrate into this. And that's a good thing. That's how it worked in 01. That's how it worked in 08. The more bullish the market got, the more people wanted to get involved in it. And for some, it's been pretty damn good, I'll say that. But here's where I'm going with today's talk. I've had this theory in the back of my mind that one of the reasons that the market is bullish is, well, we obviously know Fed intervention, but some people always ask, if the economy is so good and the jobs are growing so rapidly, why is the Fed continuing to pump money into the market? Why are they keeping rates lower? And I believe they have a big time problem. And that big time problem is, I feel that most people, and this again, this is just my opinion and theory, I have no scientific data backing this, only time will tell. But my thinking here is many people are borrowing money on their home. Let's call it like a false sense of wealth, where if you own a $500,000 home and your real estate prices are going up 20% a year, you are in fact making $100,000 a year on your home. Am I right? You're making money, significant amounts of money on your home prices. Well, this is sort of a delusional piece of wealth. It's just kind of like stock market gains, because if you don't sell the home and take any money out, then that never really existed. It's just imaginary numbers on a piece of paper. Now, if we go back and we talk about Wells Fargo for a second, these personal lines of credit were credit for people to borrow against the equities in their home. So with interest rates being at historical lows, like 1 to 2% or 3% or whatever it is, I don't know, I don't borrow money, but I know it's historically low. I get the feeling that a lot of people are borrowing money against their home as a means of income, but also a means of investing. Because let's face it, the market's been going up 10 to 20% every single year. So it makes sense if you had a $500,000 home to borrow. I shouldn't say the word makes sense. I can see how the thinking could be to borrow $100,000 against your home at 2%, stick it into the SPY, make 20%, then pay back the loan. Easier said than done. I mean, you have market exposure there. The reason I say the Fed may be doing a balancing act is I see that this is where a lot of people are getting their investments. I also feel this is where people are living this life of imaginary wealth, where they're, in fact, debt is telling me that people are not making any more money at their jobs. Inflation is getting higher, so their outlay of monthly income is lower. Like the purchasing power of the dollar is not as good as it used to be, right? So when you combine that and you start thinking about people are judging their wealth based on the values of their home, based on the value of maybe their investment accounts that are obviously going up a lot too in a really strong bullish market, Are you counting that as wealth that you have? Now, to me, I don't, because I don't consider, first of all, debt's not wealth at all. It's actually a hindrance to you. Money in stock accounts or 401k accounts or in investment accounts and real estate is really just imaginary money until you book a gain. If you don't book any gains, if you don't sell that asset and put money in your pocket physically, it doesn't exist. It's just numbers on a piece of paper. I told this story before. When I first started in 1999, I made like six figures my first year trading, but I never took a penny of that. And eventually I gave it all back and then some when the crash came. So it was like, what did that money, I didn't do anything with that money. I didn't go on a trip. I didn't pay down any debt. I didn't invest it in any education. I didn't do anything but watch it go up and then down. And one day it was like I had a bunch of commas on my brokerage statement, and the next day I had a bunch of zeros with nothing in front of it. It was just zeros, right? It was nothing in there. So to me, it's not real unless you have pulled it out of here. So I'm thinking a combination of this. Most people may have, or there's a good portion of people that have been getting very risky in this market, throwing this free government money, this easy borrowing environment money into the market. That's making it go higher. And as long as the Fed is keeping rates low, that behavior could possibly continue. I'm starting to think that maybe Wells Fargo has a better understanding of this, obviously, because they have risk management departments, and maybe they're seeing something here that's saying that if the market is to downturn, and I'm sure the Fed knows this, that if this market downturns, then there will be so much money, right? So much money lost in 401ks, so much money lost that maybe people won't be able to pay back this enormous debt, this all-time high debt that people have on both credit cards and personal lines of credit. So I guess I'm trying to say we could be right now living in one of the largest Ponzi schemes we have ever seen. And I think the Fed knows a little bit more than what they're telling us. But I'm starting to believe that maybe they don't even have an answer for this problem themselves, because we know inflation is a problem. We know they really want, or I feel they really want to raise rates, but they can't because the market can't support itself. It can't take care of itself. And maybe one of the reasons why is for that. Maybe that's part of the government's plan. Let's go conspiracy theory. I'm just riffing. I'm just thinking. We're just sort of having a dialogue where I'm the only one talking. Maybe this is the government's way of making everyone feel rich during a coronavirus lockdown, right? Because if your weekly wages or monthly wages haven't increased, you've had to deal with inflation. I mean, hell, it's like used cars are going more for the new ones. Everything is super steep. Everything's way higher this year than it was last year. So if you're making the same amount of money, everything you're buying costs more, a lot more. So, you're paying that. So if you're not making any more money, why do you feel rich? Stock market, side hustles, right? Other things like that are making people feel rich. But then again, if you don't pull money out as profits, well, it's not wealth. It's just imaginary numbers. So, if you don't take some money, I'm not telling you to take some money here, but, obviously you can see what I'm saying. If you don't take any money, who knows where this will end. So in a roundup, I'm kind of wondering why Wells Fargo did that. Do they know something that hasn't been made public yet? Do the other banks obviously know this too? They're just not willing to act on it that quick and piss off their customers. Maybe they're just the first to react because they see the game of musical chairs. I think the Fed already has an idea. They know how much money's loaned out there in homes and other things like that. So, maybe this is like the whole house of cards here, that the Fed has a very big juggling act they have to do to make sure they slowly do this and slowly go into tapering, because that's with higher debt rates, more people having more credit card debt, more people having real estate debt, inflation on the rise. The only thing that people feel that maybe they have making them money is the market itself. Maybe. I don't know. And if it starts to crumble, how much of that debt won't be able to be paid, right? How bad could it be? I know we got, we can go on with this conversation forever. I'm going to stop it here in just a second. But we know there's rents and mortgage freezes in many of these markets where there's a surplus of homes about ready to hit the market as soon as the administration lifts this coronavirus hold on. I don't know what the exact name of it is. So Very interesting, guys, to see how this plays out. At this point, the market's still bullish, so there's no reason to go against the trend. But I think maybe we're in the early stages of setting the groundwork for something that could potentially be catastrophic. It may never happen, but we should be, as traders, it's our duty and obligation to be prepared for such an event. So anyway, guys, I want to thank you very much. I hate to abruptly end it, but I'm going to because I feel like I'm just talking in circles, and that's a pain in the ass. I'm winded now, 15 minutes in. Tell me what you think about this. You got any more conspiracy theories? Shoot them my way because I love that shit. I love it. So send it my way. Love to hear from you guys. Love to hear what you got going on. Let's take it further if you want to. If you have anything else you want me to talk about, put it down there in the description box. Don't forget about the other links. Thanks for watching this video. Subscribe, blah, 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 all that good stuff. Thank you very much. I'm signing off now. Take care. I'll see you guys soon.